Anup Maheshwari, SpiceJet doesn't quite offer the business class or the first class. I don't know if you've flown that or no, but clearly the flights seem to be full. We will talk about the markets, but since we're on the topic of airlines, I mean, gruesome business, but an IPO round the corner as well. Exciting times for the aviation companies, you think?
Well, they're obviously in a bit of a sweet spot, as Nikunj was saying just now. You've got a combination of low crude, good utilization levels, less competition in some ways, and highest operating margins, and now you have a fairly nice IPO coming up. So in that sense, yeah, it's been a fairly good phase for these companies in the short run. But again, as highlighted earlier, this is a cyclical industry. So in the longer run, there are very few companies that have managed to actually sustainably create value in this sector, which is why the business models become very, very critical.
Okay, so let's talk about markets. We know your views on the aviation industry, and none of the great investors historically have ever really endorsed aviation as a sector where they want to really invest in. Anup, you are of the view that the panic, what we've seen in the month of August and September, that is over and emerging markets have bottomed out. Isn't it too early to endorse that view? Because when we know that there are structural problems in the world?
Well, there are always problems. Very rarely in my entire career in investing have we had a market free of problems. So I think that continues to be the situation now. So it's no different. I think what's important is what has really been the positioning around those issues. So we've seen some fairly significant selling in the last 3 or 4 months from emerging market funds. People seem to have given up with the whole commodity crash on a lot of emerging markets, and typically when you have a fair amount of that already represented in stock price corrections, then at some point you have to take a view whether it's all priced in or not. So I don't think we'll ever get rid of all the concerns that exist in the world at any point in time, but it's really more on a relative valuation basis. If you look at emerging markets versus developed markets, till a few weeks ago everyone was convinced that developed markets would outperform, but on a relative valuation basis they're probably at their cheapest point now, emerging markets versus developed markets. So valuations work eventually, and it does create floors for markets, and I think we're somewhere in that zone now.
So Anup, I mean, still a long way to go before we make it back to the highs. 9,000 plus thereabouts. What is the sense that you're getting from up until now to say pre-budget? Is there a chance that we may retest the new highs, assuming things remain the same and a big overhang of which way the Bihar elections are going to swing?
Very difficult to call markets in the short run, but as a trend, I think we're definitely more in the camp of expecting an uptrend generally for markets. The important thing to really focus on is when the corporate earnings trend will change, because that really is required to support higher levels of the market. And I guess the good thing is, this quarter is also very soft, but this is pretty much the last, I think, of the flat to slightly negative quarters. From next quarter onwards, because of a low base effect and some improvements, we will start seeing some more healthy rate of earnings growth back into the 15% type of range for both the December and the March quarter. And over time we'll have to see whether from a corporate perspective things start improving, so that FY17, whether that trend continues into FY17 or not. But our general sense is that from next quarter onwards the earnings trajectory is getting a little better, not worse, and to that extent we think that will help markets.
Where do you see the green shoots really coming in, Anup, when it comes to earnings? Where do you think the first signs of recovery are going to kick in sectorally?
So, if you actually look at the index across the board and you just look at all, let's say the 50 names in the Nifty, close to half of them are still growing fairly consistently at about 15%. So it's really the extremes that are causing this overall earnings growth to be much lower than the broad average or the median. So what's happening is, you've got a few largely commodity driven, oil driven companies which are pulling down those overall numbers, but we're reaching a point where right now we're seeing probably the worst point of their earnings cycle. We're actually expecting slightly better year-on-year numbers starting next quarter for some of these names that have been dragging the index. It's really 5 or 6 names really that have been causing this whole delta. And if you look at each of those names and look at where it's heading in the next couple of quarters, we get the sense that you're actually going to see sequential improvements in the absolute profits, and on a year-on-year basis, because December and March were so low last year, you will get even higher optical growth than is actually normal. So it's largely coming from the swing in one auto name and a few commodity names and oil and gas.
As we speak, our producer is also flashing returns of some of the top funds of DSP BlackRock. The micro cap fund has given phenomenal returns. Focus 25 again in one of the top quartiles. The balance fund also has done incredibly well in some of the key categories. Anup, if I just look at the flavor of the moment clearly seems to be not large cap but mid cap. Mid cap stocks on an average are trading at valuations which are higher than large cap, and historically when that has happened, that always has led to a serious market adjustment. So your performance is great, but do you think there is serious question mark in the small cap space, in the mid cap space, purely because of valuations?
It's a good question, Nikunj, because the way we're seeing this whole category right now is the tailwind of just valuation adjustment is behind us. In our own funds, the microcap fund, for instance, what we were observing is that it's not like the average earnings growth or ROE has changed over the last 3 years, yet the fund has done extremely well, and that's largely because just the overall valuations, for the same set of cash flows, people have paid a higher price. Which is why we a little circumspect on at least creating any forward expectations on these funds based on past performance or more recent performance. But the fact is that if you do have earnings growth, I think that will continue to be the key driver. So valuations, that adjustment is done. There's no extra room for valuations to really improve unless it is backed by very strong earnings growth. So the whole category, I would agree with you. I mean, relative to large caps, they're not offering the risk reward that you would normally like. But at a fund specific level and stock specific level, there are ideas that you can still pick and choose because that category is just so wide that you can actually build interesting bottom up portfolios. But you have to be very earnings sensitive, and you're obviously not going to replicate the sort of returns you've done in the last couple of years.
Actually, which was going to be my next question, Anup. The last 1 year, even if I look at your top 5 funds, the micro cap fund and the small and the mid cap fund have actually delivered better returns than some of the others. And obviously, I mean, you take that necessary care to pick up the right companies in the broader market space. But if somebody can do that, do mid caps and small caps offer potential for significantly higher returns compared to the large caps? I take your point that the risk reward in the broader space at large may not be favorable for the mid caps, but if you are willing to do that homework for the next 12 months, do the mid caps and the small caps look to be in a better spot?
Well, as I said, bottom up, there are opportunities. It's not that we've run out of ideas, but I will say one thing, as a category still, I mean, there is a category effect that works into funds as well. And as a category, when valuations are at levels that they are, then what you need to then do is expand your time frame for investing automatically if you are bullish on the asset class. So we are only encouraging people who have at least a 5-year outlook to start investing or to allocate more heavily into this category with the view that over that period it's quite likely that valuations will even out and earnings growth will make up for heightened valuations across the sector. But you have to have a better time frame. So 12 months is not enough, if you ask me honestly, to be able to give you any conclusive answer. That's a matter of just individual stocks in the portfolio and how good or bad your cycle is, and nobody can really predict that precisely. But I would say you need to stretch your time horizon a little bit now for returns from this category.
Okay. And let's spread it out to then 3 years then, Anup. What do you like the most? I mean, I believe OMCs could be a good bet, according to you. Maybe some of the well-managed private sector financials could be a good category to invest in as well. What's the top bet?
Yeah, I mean, these names clearly stand out. Private sector banks continue to be one of the best structural places to be in the entire market. You have some good, high quality, large cap private sector banks, even NBFCs for that matter, consistently delivering good ROEs, and valuations in that segment are still not at extremes. They are still pretty much in line with some long-term averages. So I'd say private sector banks seems to be probably one of the best risk reward in the market still. Apart from that, there are some opportunities that have made themselves available. So like you mentioned, oil marketing companies is an area that we are quite positive on, and our view is that these higher ROEs that they are now doing because of the deregulation and cash flow improvement are here to stay for a while, and I'm not sure markets have fully reflected those valuations into these prices. So we're quite positive on that space even now. And consumer discretionary is another area that we like, which is we're still very bullish on the Indian consumer eventually and how they will spend, and particularly in items that are interest rate sensitive. So consumer discretionary, largely the whole auto segment remains a very positive area for us. And then beyond that, it's a lot of stock picking in, let's say, industrials or a few other sectors, but that's very bottom up really.
Also, reiterate the fact, Anup, that you're pretty bullish when it comes to OMCs. What's the rationale behind this call?
Well, it's very simple. Till a couple of years ago, the biggest problem they were facing was in their balance sheet. You had very large receivables, subsidies payable by the government, and you had to fund that with a lot of working capital and borrowing, and that depressed your profits because you had to pay very high interest costs. Now that effectively the sector has been deregulated for most of their key products, what's happened is the whole balance sheet complexion has changed. They are hardly carrying as much debt anymore. The government there are no payables by the government, so to speak. So there's been a massive reduction in debt that normally translates straight away into the enterprise value of a company and should boost the market cap accordingly. And so far, whatever market cap change we've seen is largely just the phenomena of debt getting converted into market cap. We still haven't seen a formal re-rating of the sector. So the ROEs, which used to be in the region of 7, 8 or below in single digits, have now come up to about 15% plus, whereas these stocks are still trading at not very high premiums to book. So for us, that's a good combination normally of good value in a sector where the ROEs now have established a higher level.
The first port of call, Anup, when interest rates come down, like you said, is to buy consumer discretionary. But if I look at the options, I guess the options are limited. Two-wheelers for the moment are in a demand-supply mismatch. Maruti is priced to perfection. Tata Motors is more like a global player. So I agree with the fact that discretionary companies will benefit or consumer discretionaries will benefit. But for a bottom-up guy like you, how will this theme work?
I think it's a bit of a call also on how much these companies can actually surprise you with their volumes. I think conventionally when we've looked at growth from these sectors, we've always had a certain growth rate that we've planned for. But actually in the last 4 years, growth has been fairly modest. And our sense is we're actually in the early phase of a fairly substantive pickup in volume growth over the next 4 or 5 year period. There's a very interesting graph that we were seeing yesterday where if you look at passenger vehicle sales in any economy, it's absolutely directly correlated. It's like a 95% correlation with the GDP per capita. And essentially what we're saying is if GDP per capita has to grow in India, which we're obviously very bullish on, it's very logical that car sales will keep rising proportionately. And right now actually having 4 years of very muted growth, we're actually looking at some fairly significant growth years coming ahead. So while the valuations may look a little stretched, but I think it will be backed up by the growth that will come in the next few years.
Anup, I mean, tell us, that of course is the list of things that are going to lead and show signs of growth from here onwards. What's going to continue to lag, or do you think the market will have an overall move upwards?
I think what we like about the market constitution now is it's very different from what it was in 2007. It's the same index, it's the same Nifty, the same Sensex, but the mix has changed totally. So way back in 2007-8, nearly 2/3 of the market was cyclically oriented, and only 1/3 was more defensive. And right now that's exactly the opposite. Nearly 2/3 is more defensive, and by defensive I mean higher ROE with consistent earnings growth. So I'm including private banks and some autos besides the regular pharma and tech, etc. And only 1/3 is cyclical. So what we feel is, the defensive sectors normally when they go through corrections, they go through time corrections. They don't fall 70-80% like cyclicals do. And cyclicals also are sitting at extremely low valuations. Most stocks are below book. So there's a floor for them as well. So whichever part of the market we look at, we don't see very large downside coming, which is why we're positive on the upside really. It's just the mix of the market is such that it's unlikely to be in a situation where we will see very sharp corrections, which tend to happen when the market is more cyclically driven. So we're not in that phase, which is why we're not as negative.
The way you invest is that you always hunt for growth which is available at a reasonable price. And let me draw your attention to IT. At least, I don't know about how strong the growth would be, but I'm certain that valuation is attractive. Most of the large cap IT stocks, with the exception of TCS, are trading in the teens. Can IT be a contra bet, or are you genuinely worried about the word growth there?
Actually, we are a bit concerned about growth in the IT sector. This is of course a good seasonal quarter for them, but we're keeping a close eye on growth over the next couple of quarters. I think our concern is there is a bit of pricing pressure in the sector. Also, trends in the last couple of years, oddly enough, are for a little more insourcing than outsourcing. We're actually seeing American companies do a little more business internally than externally. It just looks like the incremental growth rate is not as high as we'd ideally like it to be. So I'd say at the moment we are a little cautious, although I agree with you that valuations are very reasonable. It's a sector that might do well in the long run, but again, there's just so many technology changes that you need to really keep pace with that. So our sense is we are actually a little underweight on IT at the moment, simply because of a bit of a growth concern in the near term.
There is one terrific investment which you did a couple of years ago, was 8K Miles. I will not get into stocks. I appreciate and I understand the regulatory compliance here, but the world is moving towards digital. At a time when the world is moving towards digital, how do you think the Indian IT sector per se will change? Do you think traditional IT companies will suffer because they cannot move up the value chain?
So I think companies will evolve. I mean, companies are in India very dynamic, and I'm sure they can all see these trends ahead of us as well. So they will have to adapt. It gets a bit difficult when for certain companies with existing structures to turn themselves around, but I'm sure they will. My sense is the large players generally, I would say it's a little difficult to call it today, but there are some of them who've recognized the trend reasonably well in advance and are making the appropriate changes. There will be some who will be a little slower and may lose out some market share along the way. So you have to sort of pick and choose appropriately. But there will be a lot of interesting newer companies coming up that will be able to benefit from these trends, because what we're seeing effectively is a lot of mid-sized companies coming up, not having problems, or scale actually is not necessarily adding as much value in this in the new scheme of things. It's more technology based, it's more IP based, and to that extent, if you can find some good interesting companies even in the mid-size category, there could be some interesting market cap creations there.
Anup, so let me get closing comments from you. For someone who's, let's say, planning to come in now, let's say start a SIP or has a 3 to 5 year view, what should be the broader return expectations? Because this is not 2013, this is 2015. Bulk of the re-rating of this market has been done, and frankly there are pockets where markets have run up way ahead of earnings. So what is the risk reward ratio now when bulk of the P expansion has happened?
I could sort of launch into a really long lecture on this one because we very often get asked the question on when's a good time. There's never a precisely good time. The good time is when you just start, and I think we've got to just. I've never seen any company do well with a negative frame of mind or with constantly worried about their future. And similarly, when you look at investing into equities, you have to approach it with a positive mindset, almost like a business person would, and believe the fact that eventually in the long run there is growth, there is no degrowth. There was a baby in your family and you had to give them a long or a short option on the market, which would it be? It would typically be a long option. So the point only is that we believe in growth eventually, and therefore this asset class logically has to outperform. If equities did not outperform debt over extended periods of time, there would be no logic for companies to exist, because if they can't beat debt, then they're not adding any value and they will never get a price in the market. So So the very fact that the stock market exists means that to some extent equities have to outperform fixed income over long periods of time. And if you're doing asset allocation, I don't think timing really matters. SIP is clearly the best way for people to invest, and we keep encouraging, from an early age, SIPs can create tremendous value through a cycle. Any time is a good time as long as you start and you get your asset allocation sorted out. So I'm sorry to give you a very long-winded answer, but essentially equities is more about attitude really than anything else. And I think now is as good a time as any, and it should pretty much beat most of the other asset classes in the long run.
It may sound like a long answer. It's an important that you clarified and you highlighted for our viewers that how should they really plan their investments. I mean, take a long-term bet. That's the way go forward. Equity historical evidence has suggested has always given better returns on an extended period of time, and I think that should be the basic approach. Get your asset allocation right. Anup, glad you could join us. Thank you for your time and thank you for your fantastic insights. And for the longest time, I think the channel stance also has been that gold is important, real estate is crucial, but don't ignore equity as an asset class.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.